Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. In this episode of the Moneymakers podcast, I shall be talking to Mark Boggett, who is the CEO of Seraphim Space, which in turn manages the Seraphim Space Investment Trust, ticker SSIT, which has been listed on the London market since 2021, so coming up to its fourth anniversary this year. So I'm going to kick off without further ado, Mark, by asking you to explain personally how you came to be involved in the space business. Before we talk about the trust and everything else, what drove you to get involved in the space business as a venture capitalist, which is what you are?
I'd be delighted to do so, Jonathan. Thank you for inviting me to participate in today's podcast. So I have spent my career focused on investing into technology-related companies. I've got a degree in accountancy, a master's in economics. I'm a chartered financial analyst, and I've always focused on technology throughout my entire career, starting off in the 90s, focusing on technology stocks, and then from 2001 onwards as a venture capitalist, investing into companies, joining the boards and helping them with their growth story. So always being a deep tech investor, looking for new innovation and sort of deep tech. So that means I've been investing into things like AI, new materials, a lot of telecommunications technologies, IoT, 3D printing, a very broad range of technologies that are very much the sort of industrial generation of technologies. Nearly 10 years ago now, I was looking with my partners to find a thematic area to focus our attention on. And this is when we really discovered space as a long-term thematic market that was actually all of the technologies in adjacent markets were coalescing around space. So 3D printing, AI, telecommunications technologies were sort of vitally important for the next generation of technologies that were being developed in space. So we decided to focus a fund on that. And we launched the first ever space-focused venture fund in 2016. But what was important was the investors behind that fund were some of the world's biggest space companies. Companies like Airbus, SES, Telespazio, Teledyne, Surrey Satellites. These companies also recognised that the space industry was going to be going through a revolution. That revolution was largely being led by Elon and SpaceX, but it was much broader. And they wanted to get a sort of vision as to what was going on. And our fund presented that to them to help them understand the new innovation, the new business models, and to have access to the companies. So that's what led us to setting up the world's first space fund. And we've then since gone on to become now the most prolific investor in the space market globally, today with a portfolio of 146 space companies.
So you definitely caught a trend. And of course, the great thing about venture capital is that if you can catch the right trend, you can make an awful lot of money, but it can take quite a long time and is quite a high-risk business.
True.
And I guess space is no different to that. Perhaps then we'd next ask you just to briefly explain how the investment trust, Seraphim Space Investment Trust, fits into the overall scope of what you are doing in your space venture capital activities.
Yes, so there's three parts to the Seraphim business. An accelerator program that works with seed stage companies that have spun out from universities or teams straight out of SpaceX that want to set up on their own. We've been doing that now since 2017. It's now the largest space accelerator in the world. Operates out of London for Europe and San Francisco for the US. We're now on to our 15th cohort. Each cohort's got 10 seed stage space companies globally. And we support those companies through to them fundraising and accessing the capital they need and the introductions that they need in order to be able to make that. So those companies have raised nearly $700 million to drive their space ambitions. And we've effectively taken a stake in all of those companies through that accelerator program. We've then got a private venture fund. And we're now on our second one of those. We had 20 companies in our first fund, which had 4 IPOs and a trade sale and sold the balance in a secondary, which over 5 years, we made a nice return for investors. They saw 3 times their money net over that time period. And then we've launched our latest venture fund that invests in seed and Series A stage companies. So really early, really high risk. And we do that in the private market. And then we've got our public fund, which is our growth fund, the Seraphim Space Investment Trust, and that invests into B series and later stage, growth stage companies within the global space market. We've got 25 companies in that portfolio right now, with 61% of them by now either profitable or have raised enough money to reach profitability. That portfolio raised just shy of $1 billion in 2024. So they're very ready for the market that's ahead of them in 2025. So those are the sort of three elements. And across those, we've become the most prolific investor in space. I mentioned the portfolio of 146 companies. And that leads to us receiving a giant global deal flow. So to put that into perspective, we get to see between 150 and 200 space deals every single month from around the world. We've seen nearly 10,000 space tech startups, and that gives us a unique information advantage for when we're looking to invest into this sector.
So, in other words, you've been doing this quite a long time now, and you have a global perspective on the opportunities that are out there.
Yes.
What was the thinking behind the launch of the investment trust or the growth fund? It was launched in 2021. It's one of the last IPOs we had in the UK market.
Yes.
And I guess it was a time when everybody was still very bullish and a lot of trusts were trading at premiums, particularly in the alternative sector. Was that just too good an opportunity to miss as a fundraising opportunity? And given that, what were the particular attractions of the investment trust structure that appealed to you at that time?
So the reason that we did it was more one of sort of helping the market develop. So new space is a new market. It's really only been around for 10 years, and most of the growth has really taken place during the course of the last 5 years. What we were witnessing as a venture investor, that there was huge amounts of growth opportunity. I mean, these companies take $300 to $400 million to reach profitability. So there's significant amounts of equity that's required to support these companies along the way. And whilst in the market there was a huge interest in the space domain, there was little by way of experienced investors that were sort of confident and comfortable investing into the sector. So this was the reason why we decided that we would set up our own growth fund, which can be a catalytic investor when we're investing into companies, because it gives confidence to other investors who are not naturally experienced in space that a leading space investor is leading the round and investing on the same terms of them and have done the necessary due diligence and really understands the market. So we recognized that there was a role for a catalytic investor, and that's why we set up the growth fund. We chose to do this in a public rather than private environment for two reasons. Previously, I was working at YFM Equity Partners, that runs two listed trusts, British Smaller Companies 1 and British Smaller Companies 2. So I was very familiar with the listed structure for these types of funds. And the thing is that the strategy that we're investing into is long-term growth. So the companies that we've invested into now, we believe, are going to be throwing off massive amounts of growth for the next decade or more. And that doesn't really fit within the sort of 10-year structure of a typical private fund. And it fit beautifully into the evergreen structure of an investment trust. So that was the reason why we decided to go down that route. It enabled us to be able to take more time to invest into these companies and to enjoy the growth. You know, we consider the market that we're investing into is ultimately like a new internet. We think it's that level of opportunity. And the companies that we're investing into now are the Googles and Facebooks and Amazons. And when would have been the right time to have sold any of those businesses in the past? We think the same is true of the types of businesses we're investing into right now. And the evergreen structure of the investment trust and the fact that most of our companies are sort of moving towards IPOs rather than trade sales means that we can stay with these businesses for much longer periods of time.
Now, of course, one of the issues around investment trusts, as you're very well aware, and all our listeners are very well aware, is that you aspire to evergreen structures that can raise patient capital for genuine long-term investors. But of course, in the meantime, it's not necessarily given that you will be an evergreen, because there's always the issue of what happens if your share price falls to a wide discount, as yours has done.
Yes,
so
it's a challenge.
It's a big challenge, right? So assuming that your projected returns are realistic and this will be a great long-term growth industry and you can make lots of money out of it, you've got to survive long enough in order to reach that day, as it were.
Yeah.
Have you been disappointed or surprised? What would be the right adjective to describe how the share price experience has been since you launched those 4 years ago?
Yeah. So look, all of your listeners recognise what's happened in 22 and 23 and 24. The global economy has completely changed to what it was in 2021 when we launched. Interest rates, inflation, all of those issues that we've had to deal with. And that, of course, has been a challenge in its own right. But hopefully, as we'll get the opportunity to talk to today, the underlying portfolio is in, frankly, great shape. So we've believed that we've weathered all of that very well, and that the portfolio is robust, well-financed. The portfolio raised just shy of $1 billion last year. There's not many funds that can say that. And rapidly, the portfolio companies are becoming profitable. There's strong evidence of growth across the portfolio. So what I am disappointed about, and we obviously didn't read the tea leaves on this, is that the investment trust market is just broken. And we're suffering from that. You've got the infrastructure funds, you've got the private equity funds that are all operating on 25 to sort of 40% discounts. We knock about a 50% discount, plus or minus, which is terrible. But when you put us into the sort of pecking order of the other trusts in the market, it's not something that we can do anything about until the overall problems with the trusts market is addressed. So right now, all we're doing is we've got our head down. We've got strong conviction that we've got a portfolio that's doing well, that we're in a segment of the market that is going to continue to generate long-term growth, and that will become apparent over a period of time as our portfolio companies pop one after another. We've got high conviction that that's going to happen. So we are not concerned about the viability of our future. Quite the contrary. I'm frustrated it's going to take a little bit longer to be able to demonstrate what's going on. We've got 4 companies that are lined up to IPO. They can't IPO right now in this market because of the conditions of the market. So we've just got to continue to be more patient. But we've got 10% of cash. We've got access to more liquidity in our portfolio of listed companies. We've got 4 of those. They account for just less than 6% of the overall NAV. So it's not a lot, but it's certainly enough for us to get through the next year or 18 months and then hopefully be able to see some sort of recovery both in the investment trust market as a market, but also with a number of things happening within our portfolio that will provide and inspire confidence of investors that we're doing the right thing, we're invested in the right companies, and that they're benefiting from the current environment, which we'll come on to talk about. Defence and the place that space plays within that, particularly in Europe, is absolutely huge.
Right, we'll come back to that in a moment. So what you must be feeling is that there's quite a significant opportunity cost as well in the fact that the investment trust sector alternatives are broken, as you say, because you could have raised more money if the things had carried on the way they were.
Yeah.
And you also perhaps been able to do more follow-on investments and so on. So basically, you're a little bit stalled. Would that be a fair description?
That's right. We still continue to raise money through our private funds. So the private markets aren't quite so in the same position as the investment trust market. So we do have that. But yeah, this is what I'm crying into my beer over. I've quite rightly timed a long-term growth theme. It's accelerated faster than I expected. We're a UK company that leads the world in a really important market. And at the time where we're actually at the absolute peak of that market right now, given everything that's going on in defence, I've not got one arm behind my back, I've got 2. I should be investing with abandon at the moment, and I'm not doing that. And that is what makes me frustrated.
So what do you think's the real reason here? I mean, when you go around and talk to potential investors, you've talked to wealth managers, I dare say, and investment trust is no longer a kind of big institutional market in this space. And you have some private investors, obviously, who like the story. What kind of reaction are you getting? Why do you think the share price isn't moving more? It has moved up, obviously, more recently from the low point, which was, 18 months ago. It's done quite well since then, but it's still obviously somewhere behind the NAV and the launch price.
So a large part of it is the liquidity or illiquidity of our trust at the moment. We joined as an investment trust with an expectation of raising 200 million plus for each year after we joined. So we're expecting at this stage to be $1 billion plus, £1 billion plus, and we're not there. So the liquidity is not there in our listing at the moment, as it isn't for many of the other investment trusts. So this is, I perceive, as a trust issue rather than a Seraphim issue. And then again, it's not something that's in my power to be able to fix. So what we are focused on is doing the best job that we can with the portfolio that we have. And the story is going to start playing out in the market. We do lots of programs like this. We do huge amounts of education in terms of the amount of material that we put out there. We do our own podcasts where we get all of our CEOs to talk about their business, talk about the outlook, talk about where they expect to be in the next 3 to 5 years. We do monthly updates. We've got lots of thought leadership that we do. Just released a white paper talking about defence in Europe and the place that space plays. We do a monthly update that talks about the progress of all of our portfolio companies. So we're doing everything we can do to help educate folks about what this market opportunity is. And I really just believe it's going to take a few portfolio examples where things work out, where portfolio companies are either bought or the IPO valuations materially above where we're holding them right now, that people will start to believe in the story. And, the other thing is the backdrop of what we've had over the last 6 weeks or so, with the US president really making it clear that Europe's now got to stand on its own 2 feet. You've seen European governments rapidly address that. 800 billion euros agreed within a weekend of that position by the US being made clear. 650 million being financed by countries increasing their percentage of GDP that's spent on defence by 1.5%. And then you've got 150 million loan fund that's come out of the EU. And then you've got individual countries like Germany that have allocated a further 500 billion euros to strengthen their own position in defence. And then you've got all of the sovereign wealth funds that have been told by their governments to focus on defence. So here in the UK, you've got the British Business Bank, you've got the National Wealth Fund that have had their remits changed to have a focus on defence. You've got the largest sovereign wealth fund in the world, Norwegian, $1.8 trillion, that for the first time has had its remit changed to invest in defence. So what we have now is a completely different environment to what it was 6 weeks ago. We've got a massive customer with almost $1 trillion to spend on filling their gaps in defence, which they need to do quickly. And then we've got a whole range of investors that are coming to the market with a renewed interest or with a first-time interest in defence, but not a huge amount of experience in investing in the market. So they are going to be looking for catalytic investors like us, who are specialists in this domain, that really know all of the market, know all of the competitors, and can invest with conviction in the businesses that we choose. And when it comes down to it, there are only so many companies in Europe that are going to benefit from this massive new increase in budget. And we believe we're already invested into many of those companies, but we also have identified the others that are going to benefit from it. So all of that is new. So that's the reason why I'm on podcasts like this right now, to try and help people understand how well we're positioned. 74% of our NAV is focused on defence. 62% is focused on Europe and the UK. And defence is this major play that is very clear for the next decade, and space plays an ever important role in that defence, which hopefully we'll be able to come on and talk about during the show today.
Yes, indeed. I mean, I think it's probably fair to say that I don't think you were highlighting the defence aspect of this when you started, particularly compared to other uses, but it's undoubtedly the case. And I guess most people who, if they think about this trust at all, will think that it's all to do with rockets and launching and firing pop stars into space. But of course, it's really nothing to do with that at all, is it? Perhaps you could elaborate a little bit on what the misunderstandings are and what the main focus of what you're doing is.
Yeah, well, thank you for giving me the opportunity to do that. Describing what we don't invest into is a great way of really helping people understand what we do invest into. So we don't invest into launch, rockets, anything like that. Elon's done such a fantastic job of that. And there's already a couple of hundred other companies behind him that we don't think the returns are there. So we don't invest into that sector. We don't invest in anything to do with space travel, anything to do with the moon, anything to do with Mars. And again, this is the area that most investors, when they think about a space fund, that's really where we're spending all of our time. But the reality is there isn't really a commercial market for those areas right now. Government is largely the large customer, and who knows when a commercial market will really become truly available. But if you look at the areas that we are investing into, it's about how space serves Earth and provides communication and data capabilities that accelerate what we've got today. If you look at GPS, this is a really important space-related capability that we all rely on. It's a hidden utility that we all rely on today. The UK Space Agency did a report last year that identified that 17% of UK GDP is space-enabled. So space is already a major part of our economy and what we rely on. Sadly, people just don't recognise that. And what we're investing into is really next gen. GPS is 30 years old. What we're investing into right now are all of the technologies that are really going to start making a difference to our everyday lives, subtly in the same way that GPS has done, but is also relevant to every single industry you can think of. I mean, space is dual use. What that basically means is that there's a defence and military-based customer, and then there's a commercial customer for every single satellite and every single space use case. And yeah, as you quite rightly said, when we came to the market, defence was really not something that we were shouting about from the rooftops. Defence was still a reasonably large sub-customer of the companies that we invest into. But it's true today that the majority of the companies that we've invested into are not defence companies. They don't perceive themselves as defence companies. In fact, there's only one in the portfolio that established themselves as a defence company. The rest are defence companies by accident, because what they are developing is technology and capabilities and communications that are in demand by military. Military want to be at the cutting edge of whatever's available commercially. And our portfolio companies have been finding themselves drawn into this defence market, which has only accelerated in recent years and is now set to really be the main part of our revenues for some time to come. As I said, we're already at 74% of NAV focused on defence, and it's probably going to get higher, which is absolutely fine by us, because all of the other commercial markets that we're focused on, and really, myself and the team, we set this up really to focus on clean tech and climate-related opportunities, where space is uniquely positioned to help us better monitor the planet, but also to address some of the huge issues that we've got. The extreme of this is something that we're focused on and we have invested into, which is solar farms in space to provide clean energy back to Earth, to wean us away from fossil-based fuels and everything in between. And that's really what our focus has been and was up till a handful of quarters ago, when it really started to become, post the Ukraine war, that the companies that we're investing into and their dual use has got capabilities that were designed for the insurance market, the real estate market, the oil and gas market, or big themes like climate, autonomous mobility, the drone economy, smart cities. But defence has really come and said, this is the technology that we need. We've got a big check and we want to buy it now. And this has led to those companies sort of repositioning themselves to deal with the customer that's banging on their front door.
Well, let's just drill into that a little bit. I think a lot of people obviously are aware that, for example, the role that Starlink has played in Ukraine in providing satellite information and so on, and obviously the use of drones and things like that have been very significant. But the kind of companies which are still early stage, pre-profit mostly, are they actually producing the kit that the military is going to need, or are they providing the services that will back up the kit that the governments and the ministries of defence will need?
So you keep referring to early stage, but I think that that's probably not the right description of the majority of the companies within the trust. 61% of those companies are now either profitable or have raised enough money to reach profitability based on management's own forecasts. And many of them are now sort of $1 billion in valuation. They've got 750 employees. They're growing at more than 50% per year. They've got hundreds of millions in revenues and bookings. So I wouldn't refer to them as early stage. I think early stage is our private portfolios, where there's still tech to be proven and risks around those areas. These companies in this portfolio are largely already got customers, the tech's developed, it's used in the market, and they're now scaling those businesses from low millions to hundreds of millions, and our expectation into billions in the near future. So just to give you our position there, are they being used right now is your question. The answer is very much yes. And if you look at the sort of top end of our portfolio, the top 10 companies that account for 75% of NAV, they're all got significant customer contracts with defence organisations around the world and are playing a significant role in particularly supporting Ukraine. So I'd be happy to talk about a couple of the companies if you wanted me to give a sort of flavour of just what they're doing and why it's so important.
Yeah, of course. Please do.
So we'll talk about ICEYE, which is our largest holding within the portfolio, 22% of NAV. This company is the market leader in providing radar imagery in the world. And what they've developed is a miniaturized satellite with a miniaturized radar. And what that enables them to be able to do from space is look down at Earth in 25 centimetre resolution. That means that they can see millimetre movement. They've currently got a constellation of 48 satellites. And that means that they can see every square meter of Earth every hour. And because of the properties of the radar, they're able to see day or night, and they're able to look through any cloud or any weather to reliably see the ground. The company then runs change detection AI algorithms to determine how that square meter of Earth has changed in the last hour, the last day, the last week, the last month, the last year, to build up an understanding of that particular point on Earth. So if you think about GPS, the blue dot in your mobile phone that's generated tens of billions of dollars of enterprise value per year, that's 3 pieces of information: longitude, latitude, and time. The green dot that's created by our portfolio company ISI has hundreds of pieces of information about how that spot on Earth has changed over time. And this is really why it's so in demand by defense organizations around the world. They were first used in the Ukraine war, because Ukraine didn't have any of its own satellites. They quickly looked to the commercial markets to find capability. They selected ISI, and that's really acted as a sort of shop window for the allies and the rest of the world to see the incredible capability that these guys are able to bring to the field. And now, as a consequence, many governments around the world are looking to have this kind of sovereign capability by buying this directly from ISI themselves, because this kind of level of capability can't be found anywhere else. And this is a new space company. It's doing all of this at low cost. Very low cost satellites, very low cost capability. There's been a revolution in this type of capability that now governments and defence are now looking to leverage.
So that's one. Can you give a second?
Yeah. So another company that's in our top 3 is called Allspace. This is actually a UK company. ISI is from Finland. And what they've developed is a new kind of antenna. And this goes on the back of any moving vehicle, a tank, a car, a boat, a plane, a train. And what it enables it to be able to do is connect to multiple satellites simultaneously. And those satellites can be in any orbit: low Earth orbit, mid-Earth orbit, or geostationary orbit. And that is unique. So traditionally, these antennas have only been able to connect to a single type of satellite, and that you had to have a contract with that satellite, and it was just this one-off walled garden arrangement. And what effectively this is enabling, first of all, defence to be able to do, but secondly, the commercial markets, is to be able to connect to any satellite, so that it actually provides resilience, particularly in defence, where you've got the aggressors that are trying to spoof GPS satellites or completely take them out. This is another way of being able to get both connectivity, but also navigation, understanding of where that antenna is on the ground in a new way. This is a flat panel antenna, so it has no moving parts. It can be produced cheaply, and is really sort of revolution in this market. So they've been through the process with various militaries around the world, including the US, and they're now scaling up their operations to meet with customer demand. And this is exactly what defence is looking for, this capability that allows them to have resilience, both around connectivity and around navigation.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So there's always these same questions that occur, even if this is a new market, if you like. If you're one of these companies developing this new technology, you obviously need funding, you need scale, but you also need to ward off competitors, right? You need to be wary of others coming along and doing the same thing.
Of course.
I don't know how controlled it is, the number of satellites you can put into space. Obviously, it's going to be a lot more over the next few years. But what are the risks around the companies you're investing in They're scaling up, but can they sustain their competitive advantage? I mean, technology history suggests that there will be some challenges to do that.
So this is a big focus of Seraphim in helping companies to be able to do that. So first of all, we try and invest in the emerging category leaders. And they're doing things that have never been done before because this is all new. So what we ensure that they do is that they are taking out patents in every stage of their process in which they're doing. And we like to invest into vertically integrated satellite constellations that both design their own satellites, build their own satellites, operate their own satellites in space, they develop their own software, they develop their own AI capability, and then they have relationships with the end customers who then feed that back quickly into that design loop so that they can get the customer understanding right the way operationalized. And at every stage of that process, they write many, many patents that in due course then get granted. And they build themselves a giant patent portfolio that makes it very difficult for those that come behind them to operate. Now, they don't prosecute these patents straight away. They allow other competitors to develop. But over time, they've got this position that they can fall back on, where they can go back to later competitors and challenge them for using their patents. So we believe that these companies are building very sustainable positions through patents, but they're also at the cutting edge of the development of this market, which goes back to the point about the vertical integration. This is one of the things that's made SpaceX so successful, is it's vertically integrated. The speed with which it can go from one version to another is breathtaking. And this is the reason why we take the same approach when we're investing into satellites that also get the same level of capability improvement from one version to another, all of it being patented. One of the things that I say to help people really understand this is that what the company will do is it will identify a problem that they've got in the space environment, they'll fix it with the next version, and they'll understand what the optimum way of doing that is. They'll say that to themselves then, right, we found the optimum way to fix this, but what are the 3 or 4 other ways that someone else who comes behind us might want to fix this as well? And they patent those as well. So they're really building an incredible sustainable position by spending a lot of money on patents. And we think that that is really going to be very much part of the valuation of these businesses at the time that they come to be IPO'd, or in particular when they come to be acquired.
We know that the private equity industry generally is all gummed up at the moment. There aren't many realizations, and therefore raising follow-up funding is difficult and so on. The whole cycle is a bit slowed down. Is that a particular problem that's afflicting you as well at the moment? Is that actually an issue for these companies? You mentioned these companies have raised a lot of money. They're not as stuck in the mud as other parts of the private equity world. Is that right?
That's correct, yes. We produce a quarterly publication called the Seraphim Space Index that's available on our website. And what we monitor, the actual index element of this, is we compare space versus global venture. And we look at the amount of money that's being invested per quarter, indexed back to 2018, and also the number of companies that are getting financed each quarter. And on both of those measures, after a downturn in 2022, the space market has been bucking the rest of the markets by growing strongly quarter on quarter since the mid-time in 2023. So there has been considerable growth of investment in the space market over that time period. And it's because of the backdrop of the Ukraine war and Israel, the threats of war between the US and China, and also just the maturing of the capabilities of the types of companies that we're invested in, which has brought new investors to the market. So private equity is coming into the market, sovereign wealth funds are coming into the market, corporates are coming into the market. So there's lots of new entrants coming into this market that are interested in space. So what we haven't seen is an issue with our portfolio companies raising money. And this is why I referenced the near billion that was raised last year. Very sadly, though, I mean, we've got an international portfolio. The UK accounts for about 25%. When I rank the companies and look at what's happened in the US, Europe, and in Asia, and I look at the experience of those companies versus those in the UK companies, out of all of the companies internationally, have had the hardest time over the last 2 years raising money. But nevertheless, when they've needed to, they have been successful. But it's taken them twice as long, it's been twice as hard as their peers within our portfolio.
And why is that, do you think?
The general appetite of investors here in the UK for the types of areas that we're invested in. There's a sort of bias towards not wanting to invest in capital intensive type companies, of which we are really focused on. much prefer to invest in the sort of downstream areas of space than the upstream. And, we've been focused on the upstream, and rightly so. That's where the market is today. So there's just been some challenge around a sort of mismatch in the UK in particular around having enough investors that want to make those types of investments. Whereas over in the US, and increasingly so in Europe and in Asia, there's just much more of a willingness to back those types of companies.
Well, that's disappointing, of course, and if it's compounded by the issues affecting the investment trust market as well, or perhaps that's just reflecting a similar kind of mindset.
It is.
Can I just drill down a bit further, though, coming back to the trust itself, exactly what you said about where the companies in the portfolio are? You said that more than half by NAV are either profitable within 12 months of becoming profitable. Is that what you said? I want to be precise.
I said that 61% are either EBITDA positive or they've raised sufficient money to reach EBITDA positivity based on management's own forecasts.
Right. That's not quite as absolute as saying that you expect that to happen.
So I believe that, and we've already witnessed this in the first quarter, that management forecasts are moving upwards rather than downwards because of the market in which they're selling into. Defence is 74% of NAV at the moment, and we expect that to grow over the quarters ahead. And because of the market environment, they believe that the outlook is improved. So we're expecting positive results from the portfolio.
But I guess if you're a manager of one of these companies, you're bound to be optimistic and talk positively about the future.
Well, this is about their own budgets that they've set. So against that, it's about how much money they need to raise, what their costs are, what their hiring plans are, what they can produce in the 12 months ahead. So they don't tend to be too optimistic in that. They have to be realistic, because if they aren't hitting their own numbers, it's harder for them to raise money in subsequent rounds. So the management teams do try, and the boards, don't forget that we sit on the boards of many of these companies as well. And we're really guiding them towards trying to be as accurate as possible on what their needs are for the year ahead. And again, these companies are, on the whole, more mature companies. They're in the scale up of their operations and really understand the importance of giving investors confidence that they're hitting their own numbers.
Right. I'm sure you can see where I'm driving at with this question there.
I can see exactly where you're going.
I mean, you've got your first continuation vote coming up next year, and second half of 2026, I think it is, in about 18 months' time.
Yeah.
How confident are you that the picture you'll be able to present will have seen these expectations from management vindicated? In other words, you'll be able to come along to the investors and say, look, here are these companies which, when we started, they were all at this stage. Now we're in this stage where X% is making money and we can see a clear future ahead. How confident are you that you can come up with a story there that will be, in concrete terms, irrefutable evidence of your progress since you started 5 years ago?
Yeah, we're really confident about it. It's not something we're losing any sleep over, concerns that a continuation vote wouldn't be successful. But maybe now's the time to drill into Space Tech's position within defence and what the sort of outlook for Europe is, and why this portfolio is very well positioned for what's going to happen during the next 3 to 5 years.
Right. The other question I would have, just speaking from an investor's point of view here, when I look at the company, you do provide quite a lot of information about the trust. A lot of it is aggregate, if I can put it that way.
Yes.
And then my colleague Stuart did a profile of 3 years ago, I think, 2 years ago maybe. And he quoted, for example, there's a company called D-Orbit, which is your second largest holding.
Yes.
And at the time, you included a summary P&L and cash flow projection for that company, which was quite interesting because that had it making a gross profit of 223 million euros in 2024. Now, that's valued at the moment in your accounts, I think, at about 32 or 33 million sterling, which is obviously a slightly different number. But we don't know, I don't think, what percentage of that business you own and how we can arrive at that valuation. You don't give that sort of information, do you?
So look, we are investing into private assets. We're a public fund. And what we have to do is we have to protect our private companies, because the valuation that they are raising money at is private to them. It's also an important figure when it comes to the next round of funding as to how much new investors will pay. So one of the things that we need to do is to keep that information private, because otherwise it could negatively impact the future valuation of that company. Let's say, for example, we had a particular company that we were holding at a 50% discount to the price of the next round, and that we were actually going to do that in a public way. How is that going to help a company raise their next round at a price that's above the price of their last round. So that kind of information being in the public domain is really unhelpful to our portfolio companies, and as a consequence, unhelpful to our shareholders by publicly sort of setting valuations that can then be used against those companies. So we do everything that we can do to try and make sure that we're not doing that, because ultimately, if we do that and it does cause issues for our underlying portfolio companies, we're not going to get new companies who want us to be their investors. And that's, again, not helpful to our shareholders. So there's just a delicate balancing act that we play here in trying to give the market the information that you need to understand what's going on within the portfolio, and us to protect the interests of our underlying portfolio so that this kind of data isn't used against them in future rounds.
Right. That is a challenge. That is a challenge from an investor's point of view. I can't work out how well this particular company is doing relative to what it was expecting or projecting, which I know is a bit of nonsense anyway, but all those 5 years ago. But it was used as a kind of illustration of how exciting this business was and how fast it could grow. But there's no way I can actually look at that and say it's ahead or behind. I suspect it's a bit behind that projection. Is it ahead or behind where it was meant to be or where it thought it would be?
Yeah. So that's why we do everything at the aggregate level, to give an understanding of what's going on across the portfolio. And we think that the aggregate numbers look and sound really good. We provide aggregate growth rates of revenues, the amount that they've been funded, the percentage of companies that are funded, the percentage of companies that are profitable. So we give as much information as we think that it's appropriate to give, whilst protecting the privacy of the companies that below that.
Yeah. And it's a challenge, particularly for a lot of alternatives, because there is this difference between the share price and the NAV, and it's quite difficult to justify it just by saying, oh, well, we value it at this, and the management expects that. I guess there is a trust element, and people have talked about the difference between what's happening in the private sector, what's happening in the listed companies. And I think that's something you've experienced as well, isn't it? Well, you don't have any listed companies in your portfolio, but they haven't performed quite as well as the private.
No, they haven't. We've got 3 companies that came to the market via a SPAC. 2 of them have done terribly, losing about 90% of their value. One of them's, I think, 5x up. So we've had swings and roundabouts with our experience with our listed portfolio. And that is what it is. It's kind of outside of our control. The private portfolio has been performing well. They've been raising massive amounts of money, growing quarter on quarter. And the listed portfolio accounts for 6% of NAV. It's now almost irrelevant. And we've got these companies that are well-financed, well-positioned, focused on defence, focused on Europe, at a time when everybody's aware that there's massive amounts of money that has been committed to this area, and governments rapidly need to move to address capability gaps. And we think that we're well placed to be able to do that. Time will demonstrate that. We've got 4 companies planning to IPO. There's an expectation that some of the companies are going to get bought because of their unique defence capabilities. And all of this is going to play out during the course of the next couple of years. How quickly, I don't know. What are my confidence levels that it will play out positively? Very, very high. Hopefully that's coming across in this podcast. And yeah, the worst thing that could happen, and I'm on record many times saying this, is that some of our top portfolio companies get bought tomorrow for a 3x or even a 5x, which of course will make everyone super happy, apart from me and my team, because you've got SpaceX that's valued at $350 billion. And we've got our leading portfolio companies that are today valued around $1 billion, growing very, very quickly. And we believe that they are going to turn their revenues, which today are in hundreds of millions of dollars, into billions of dollars over the years ahead. There's a customer there with budget that is desperate to start deploying that. There's massive amounts of other investors that are coming in, wanting to invest into one of these areas. There's very few areas right now that you can really look at and have confidence that are going to grow over the next decade. AI is clearly one of them. And I think defence is another. And for those that are educated in space, they know the important part that space plays in that defence market. So we've got a high degree of confidence about what is going to happen within the portfolio. And hopefully that will then result in a narrow discount. It will enable us to be able to fundraise and get on with the job that I set the organisation up 10 years ago to address.
Well, I'm sure we all wish you well with that endeavour. So the next 12 months are going to be very important ones, but hopefully ones that will produce some positive signs like IPOs or realizations of some sort or another.
That's right. But on top of that, our portfolio companies are doing really important things. They'll be making money for us, but they're defending values of liberal democracy. They're making us safer. And they're addressing gaps that have been created by the withdrawal of the US in their support for Europe. We need to have the types of capabilities that our portfolio companies are providing to make sure that we are safe in our homes. So it gives myself and the team, makes us very proud of the companies that we're investing in, and particularly where we're backing UK champions like All.Space that are, on the cusp of really delivering against some of the biggest challenges that's faced by defence at the moment.
So final question, you mentioned earlier you've got about 23 million or something in cash. Last year you did sell a piece of one of your portfolio holdings to raise about 3.5 million, something like that.
Yeah.
Are you going to have to do that again this year? I mean, in other words, can you get through without having to sell some of the crown jewels?
Yeah, we can do. We've just been really careful with our cash. The portfolio's raising money with relative ease, and we've not had to participate in every round. We've taken controlled dilution. We've continued to make new investments. We made one new investment in 2023, which is into a telecommunications company that is doing fantastic. They are providing connectivity direct to a mobile phone from satellites. For those of your audience that have got iPhones, you'll know that wherever you are now, you can connect to a satellite just for SOS. This portfolio company provides the same capability to all of the other Android phones so that they've got that same capability. And they're going to move on beyond SOS into messaging and WhatsApp and video and all of that over the quarters ahead. So that business is in great shape and growing very quickly. And then last year, we invested into just one new company, which again, we think is in a great position. It's a nuclear power battery. Nuclear power batteries were an important thing for the Apollo era, but they weren't commercializationable. Whereas we've invested into a company now that is nuclear batteries, the size of a microwave. They provide 10 years worth of power. They're designed to be very safe and modular. And they've got contracts with NASA for satellites, DoD for ground-based infrastructure, and also with other companies for submarines to patrol the seabed to monitor the internet cables. So this type of capability is very much the trend of energy, the trend of nuclear, and you can see scenarios in the future where boats and planes and other vehicles will be powered by this type of activity, not to mention buildings that are built permanently but don't have any connectivity to the network, where they've got reliable power that doesn't rely on wind or solar to meet its needs. So we are being very, very selective about the companies that we are investing into. And those two companies were ones that we just couldn't say no to. So I'm sure there will be other companies in the years ahead that we can't say no to. And when it becomes necessary for us to sell other companies to access the cash to be able to do so, then we'll do that. The majority or a significant proportion of our larger companies, there are liquid private markets for us to be able to sell secondary holdings for these businesses. SpaceX is the world's most liquid private company, is a space company, and as a consequence, many of the other space companies are also highly liquid. So yeah, we can always dip into that piggy bank, and as I mentioned, we've got 4 IPOs that are being lined up. One of them is already announced through the SEC, and we hope that one will happen sooner rather than later with Voyager. So they will also become another element to our piggy bank that we can dip into if we see an opportunity that we just can't let pass.
And all of these decisions you're making are superior to actually buying back the shares at a...
Yes. I mean, everything for the returns of the companies, we believe, surpasses the return of buying back our shares. We did do it last year and it worked whilst we were doing it. And then we went straight back to where we started from. So it really didn't have the impact that we hoped for sustainably. And, hopefully from the couple of companies that I've just profiled there's an understanding that the money has gone into assets that we believe are going to provide us with many multiples of the type of return that we would get from just buying back our own shares.
So that was Mark Boggett, the CEO of Seraphim Space, manager of the Seraphim Space Investment Trust.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.